Hello, welcome back to video 2 of Applied Portfolio Management. So in yesterday's video, we learned all about risk and return and how investors think about these things. So how does a portfolio manager look at investment opportunities and how do they decide, what is risky, what's not risky, and what should they invest their money in based upon that. So today we're going to look at asset classes. So essentially all of the different things that an investor can invest in. We're going to say, what are these products? Why would a portfolio manager be interested in investing in them? And how are they likely to do with their investment? So let's get going. So the first thing we've got here is sort of the simple investment types, and we've got corporate bonds, preferred stock, and common stock. So it's essentially kind of the capital structure of a company. And by capital structure, I mean when a company raises capital in order to go into business, they might issue securities like these. So a bond is money that they borrowed, right? They issue a bond and they receive money and they have to pay an interest rate on that. That is the highest in the capital structure. And what that means is that they will have probably the lowest expected return, but it's usually the safest return. And should the company go bankrupt, they are the people who will get paid out first. So the equity holders will go to zero before the bond holders lose anything. I'll skip by preferred stock and I'll go to equities and then I'll come back. So if we go to common stock or equities, that's the lowest in the capital structure. So that is the equity ownership, the part of these are the people who own the company rather than have lent money to the company. But that means that if things go well, they get all of the upside or most of the upside. And if things go badly, they get all of the downside. Or most of the downside. So if it goes wrong, the equity ownership is the first of these investment types to go to zero. And then in between them, we've got preferred stock. And there's often other things in there like warrants and all sorts of other possible securities. But we'll just talk about the basic ones to start with. And preferred stock is something that's quite common to see. And it's higher than common stock in the capital structure. So it's sort of safer than common stock. It usually pays a fixed dividend and doesn't get to vote. So they're not really the same. They're somewhere, we call this a hybrid security because it's somewhere between a bond and equity. And other things like convertible bonds will be similar as well. We'll call those hybrids too. But anyhow, these are the types of investment, the sort of simple investments that are available to many people. And I guess we'll walk through them and say, why would people choose one versus the other? So usually I teach this in a live class and I ask the students to discuss, to explain to me, why would you buy equities? Why would you buy bonds? Why would you buy an investment class like property? Or why would you invest in alternatives like hedge funds, private equity, venture capital? This is a video, so I can't ask you those questions, but maybe it is worthwhile thinking through what your answers might be if you were in a class. So we'll start with equities. Why would an investor want to invest in equities? We've just said that, if the company goes bust, they're the first to lose their money. So you might think, well, that seems unattractive. But, the equity holder is also the owner of the company, right? And if you think about, often people think about stock markets as sort of just numbers that move around on the screen. But actually, you own, when you invest in an equity, you own part of a company, right? You own shares of a company. And if the company does well, you make money like you would if you owned an actual business like a shop or a shoe manufacturer or a medical firm or whatever it might be. And so owning a company has an expected return that relates to how well business does, right? And so if you own the company and things go well, you make lots of money. You basically get to keep all of the leftover money after the bondholders have been paid the interest rate. So if you think about the bondholders as a bit like, if you borrowed money from a bank in order to open a business, the bondholders are like the bank. You have to pay them first. You have to pay them the principal and interest on the loan. But any upside comes to you because you were the business owner. And so when you invest in equities, you get that. And in the long run, there's actually a good argument for why people should invest in things like equities. And it's quite simply this idea that businesses tend to make money in the long run. If you look at all of them out there, if you look at what makes up an index like the S&P 500, you've all these companies like Amazon and Apple Computer and, Google and, I don't know, you can list them all off, ExxonMobil, all of these big companies, and they're all out there. They've got employees that come in every day and they work and they try and create value and earn profits for the company. And as an investor, you get those profits. Now, equally, if things go wrong, you do lose money. But investing in that company is sort of being someone who receives this stream of business profits. And so that is why an investor might invest in equities, for example. Why buy bonds? Well, bonds are a loan to a company, so they're less risky, and that's attractive, is to take less risk. They're less risky than equity. You won't get as high a return, but you also get a safer return, and that might be attractive as well. So you can lend money to a business in the way that a bank might have lent money to the business we just spoke about. And if you make that loan, and it's a good loan, and the company eventually is able to pay it off, you receive an interest rate, and it's a steady payment of interest, and eventually you get your principal back. And so that might be attractive to investors. Now, other things that people like to invest in are things like property. So what do you get if you invest in a property? Well, if you invest in a property that you own and live in yourself, that's not really an investment. That's just a thing you own. But for it to be a true investment, it might be a buy to rent property. So you bought a home, you maybe had to borrow money to buy it, and you rent it out, and you get the stream of cash flows that are associated with the rental yield on that property. And so what's your expected return? Well, if the property increases in value, you get that increase in value. If it doesn't increase in value, you still get the cash flow, the rental stream. And what else might you get? Well, there's other things. There are costs, right? Because a home is, people often like to talk about how safe bricks and mortar are, but unfortunately as a homeowner, you realize that you also have to constantly repair your bricks and mortar. And so every 20 years, a house might need a new roof, and wood rots and doors need to be replaced and new kitchens are needed. So you also, the thing going against you is, of course, the repair cost of that home. And in most parts of the world, you might have to pay some sort of property tax as well. And so that's another cost associated with home ownership. So why would you invest in property? Well, it's really to receive that stream of rental payments, and hopefully you are compensated for the risk you're taking in buying a property and renting it out to someone. And that is why someone would invest in property. Now, will property prices go up? We don't know. They have in the past, but there's equally periods of time in which they have not. And we'll talk about that a little bit later. What about other things you hear about, like hedge funds or private equity or venture capital? Now, we're going to talk much more about those in the classes that I put up next week. But for this class, we'll just talk about where they fit into your portfolio. Like what do they give you as an asset class? Now, a lot of times people just think that these are just the good version, a hedge fund just is the smartest guy managing my money. But that's not fully what these things mean. Usually the reason that people are investing in these what are called alternative investments is because the investment manager is supposed to be doing something unusual and different. And we'll learn about that next week when we talk about, what all these hedge fund strategies are and why you wouldn't expect them to give you the same return as just investing in the stock market. Because if it was just the return of the stock market but a little bit better, the question is how valuable is that? The real thing that you're getting from these things, or at least a professional investor will view these as giving them diversification, right? So most of the reason that people invest in these types of assets is to get the diversification benefits. They're hoping that if things go sour in the stock market, that maybe they've invested in a hedge fund that does convertible bond arbitrage that might still be doing well, or that does a volatility arbitrage and is still doing well, or some sort of commodities trading business that does well. And so the idea is that if you invest in hedge funds, private equity, or venture capital, that you have access to a return stream that isn't available in our traditional asset classes. So that's really what it's about. It's about trying to get an uncorrelated return. And as we saw in the last class, an uncorrelated or a low correlation return is quite attractive to investors because it dampens the volatility of their overall portfolio. And the reason people want to dampen their volatility is quite simply that if you have two expected returns, if you have one portfolio that goes up smoothly and another that goes all over the place and have the same end result, and you might say, well, if I have a 20-year time horizon, what's the difference if I end up with the same amount of money? But the reason you would want the low volatility one is, what if something went, what if something unexpected came up like halfway through, if you thought you were holding for 20 years, but 10 years into it, you lose your job and you need the money, or you fall ill or something like that and you need the money. With the low volatility one, you are more likely to be sort of smoothly earning money rather than at a high or a low. And of course, the thing you're worried about is being at a low at a point in time in which you need to cash in your investment. So that's why low volatility might matter. So the role of fixed income investment. So the first thing we're going to talk about is fixed income, which is bonds, and what their role is within a portfolio or a professionally managed portfolio. So the first thing is to provide income, right? Because mostly when you invest in bonds, they pay an interest rate. There's a coupon associated with that bond. And so there might be a quarterly or a semi-annual cash flow associated with it. And some investors want that. They want to be receiving money. We'll say, for example, if you're retired, you might hope to live off of the interest payments that you receive and leave your principal invested in bonds. So to provide income is one of the reasons. To provide low volatility returns is our next one. And that's simply just, it's a conservative, a safe sort of investment. So the kind of person who invests in bonds doesn't want things to be too crazy. They want it to be nice and calm, that you receive your coupon payments every quarter or every 6 months, and that there's no big gains or big losses happening in there. Another reason might be to speculate on interest rates, and we'll talk about that a little bit more later. But essentially, bond prices change when interest rates change. And so if interest rates go down, bond prices go up, and thus you might invest in bonds simply not for these ideas of low volatility returns or to provide income, but simply if you feel interest rates are likely to fall and you think the market doesn't realize this, maybe you can buy bonds, and then when interest rates fall, your portfolio of bonds will go up in value, and that's something that you can do. What else? We've got to speculate on credit spreads. So credit spreads are the difference between what a risky bond pays in interest and a low risk bond pays in interest. So we'll say, for example, if you saw a company and you thought they're risky, or they look risky right now, but they're going to be less risky in the coming years for whatever reason you've come up with, that this is your theory, you might say, well, I can invest in this bond, and we'll say it might be yielding 7% and the risk-free rate is 4%. So 4, 5, 6, 7. So you're getting 3% of excess return, but that's compensation for the risk you're taking. So that's the credit spread. And you might say, well, if if things go well over the next 6 months or a year, that credit spread might reduce, and thus the bond will increase in value. It'll go from being a high risk to a low risk investment, and thus it'll be worth more, and you'll be able to sell it on at a profit. So that is another reason to invest in fixed income. Tax advantages are also a thing, that there are certain types of bonds that are tax advantaged in the United States. Things like municipal bonds and government bonds have certain tax advantages, and there's certain types of investors who will do well if they invest in that type of asset, or they'll do better than you would initially expect, and it just relates to their tax situation. And then finally, return objective. There's certain types of investor, and they're actually required to invest in this type of thing. So things like pension plans and insurance companies are only allowed to take a certain amount of risk, and also they might have just a certain return objective where they need to make a certain amount, and if they can get that in a low risk way in the bond market, they should do that, but often they're also regulated, and they're required to put a certain amount into bonds, and then they can only invest in bonds with a certain level of risk. And so that's another reason that people invest in fixed income, is because they are required to by their investment mandate. So that is the role of fixed income investments. What about the risks of fixed income? Well, there's a bunch of different risks we have here. We've got default risk, the risk that the borrowed money will not be paid back, either all or some of it. And that does happen from time to time. So that is a real risk in bond investments. Interest rate risk. We pointed out that there's a way of making money with interest rate. If rates go down, bond prices go up. But equally, if rates go up, bond prices go down. So you could lose money due to changes in interest rate. Credit, we sort of said the credit spreads could narrow and make you money. They could equally widen and lose you money. Inflation, if you put your money in a bond and then inflation kicks in and is higher than the interest rate you're receiving on the bond, you'll essentially have your wealth being eroded by inflation. Currency exposure, if you invest in foreign bonds, you're exposed to the risk of that. Duration and convexity, we're going to talk quite a bit about that, I think, in an upcoming class, probably not today, but they are the risks of, they relate to interest rate risk. They're sort of how risky a bond is. If duration is how much a bond changes in value for a given change in interest rates, and then convexity is a sort of an adjustment to that. We'll explain that later. Liquidity. So liquidity is a risk with fixed income investments, in that sometimes, with equity investments, they're often bought and sold all the time. So if you buy a stock, you can usually sell it again reasonably easily. With bonds, actually, people often buy them and just hold them till maturity. And so if it's not part of a big issue, it may be a little bit difficult to try and sell it in the secondary market, and maybe you have to sell it at a worse price than you wanted to because of that. Reinvestment risk is sort of a fixed income idea as well. It's this idea that, when you put your money into a bond and you're receiving these quarterly or semi-annual payments, the interest, that what if when you receive that, you have to invest it at a lower rate because interest rates have come down? Or even when the whole bond pays off, we'll say if you were in a bond that was yielding 6%, and by the time it pays off, the new bonds that are available are only yielding 1 or 2%. Well, therefore you've got this reinvestment risk. So that's another risk. And credit spread risk, which is the widening or narrowing of credit spreads. And so these are all of the different risks built into fixed income investments. Equities. So equities are stock or ownership of a company. Common stock is a form of corporate equity ownership. It's a type of security, and it's called common to differentiate between it and preferred stock. And in the event of bankruptcy, common stock investors receive their money after everyone else has been paid off. So common stock on average performs better than preferred and bonds, right? It's this sort of risk-return trade-off. It's that you've taken the risk of actually owning the company rather than lending money to the company. And so the risk you're taking hopefully will be compensated. And if things go really well, you've got all of the upside, and the lenders don't. They have a fixed return which is tied to the interest rate that they lended money to you at. So that is equities. So common stocks, rights and power. So what do you get if you invest in equity? I said you own a company, but what are the rights of ownership? Well, you have the right to receive dividends. And so a lot of companies, if you invest in the stock, they'll pay you a dividend. If they have earnings to come in from their business, they then might pay that out to you as an investor, your share of the profit. So that's a dividend. You have the right to sell the stock, right? So if you own the stock and you've decided that you want to get out of it, you have the right to sell that on to someone else. And obviously that's an important and valuable right. You have the right to receive consideration in a merger or any other fundamental transaction. That means if the whole company is bought out because you owned a share of it, you get paid a share of whatever the buyout value is. So if you get treated fairly when a merger or some other big corporate action occurs. And what else? The right to elect directors and approve fundamental transactions. So the directors of the company, the board of directors, are there to represent the equity holders. They don't represent the other security holders. They represent the equity holders. And you have the right to elect them and to make sure that there's someone in there that is representing you and your desires as to how the company is being run. And finally, the right to receive a proportionate distribution of assets on corporate liquidation. So should the company go bust, once everyone else is paid out, if there's anything left over, you have the right to receive your share of that. So that's what you get when you when you invest in an equity, is you get those rights. That is the rights and powers of an equity owner. So asset class returns. So let's look at this, because obviously this matters. How do these different investors typically do? Well, we've got here a chart of stocks, 3-month bonds and 10-year bonds from 1927 through till present. And so as you can see here, the stocks do the best. The stock market tends to outperform these other securities, and that's tied to this idea, the risk return idea, that you wouldn't invest in stocks if you didn't usually outperform these other securities, because you'd rather be in these lower risk securities otherwise. So stocks is up here in the top. Then we've got 10-year bonds doing worse than stocks, but better than 3-month bonds. And the lowest return is going to our 3-month bond holders. But equally, that is the lowest risk security of the three. And so we've taken this from Stern NYU. That's where I got this chart from. So let's look at it numerically. Like, what would you have gotten if you put $100 into each of these three asset classes starting in 1927? So if you'd put the money in stocks, you'd have $548,199 by now in 2020. And that's after the market has just fallen rather significantly in the last couple of weeks, but you've still got $100 turned into over $500,000 for you. 10-year bonds, you'd have about $7,500, and 3-month bonds, you'd have a little over $2,000. So as you can see, I mean, it's not that stocks do a little bit better. They do an awful lot better, and this is largely tied down to compound return. In a given year, they might appear to only do 1% or 2% better, but when that compounds out over 93 years. It turns into a rather significant difference. And that is why people invest in stocks. Like, that's why people want to buy stocks and take that additional risk, is that there is, or at least has historically been, a significant excess return associated with that type of investment. So asset returns in the UK. So we've got here UK equities, gilts, and we've then got T-bills, so American T-bills. And as you can see here, the gilts and T-bills did about the same. Like, there's periods when one outperformed the other, but overall they're doing about the same. And once again, equities is hugely outperforming these fixed income investments. And that is something that shouldn't surprise you too much. And that's a longer chart, actually. That's 1899 until present. And property. What about property? We talked earlier about you can invest in property. Why would you do that, and what do you get? Well, property usually has a low correlation to equities, right? So that's one reason. It might help you diversify if you invest in property, because it shouldn't be going up and down exactly in line with the stock market. Now, in truth, they will be tied in that if the stock market crashes, you might have a harder time selling your home than if the stock market is booming, but they are less correlated than than one equity is with another. Property price less correlated with that. Property is interest rate sensitive, though, and let's think about why would property be interest rate sensitive. Well, it's worth thinking about how people usually buy property. They usually don't, you can buy it however you want, but most people don't typically buy just using cash on hand. They borrow money in order to buy a house. They get a home mortgage. And whenever you're borrowing money, if the interest rate is lower, you're able to borrow a greater amount of money than if the interest rate is high. So there is an interest rate sensitivity in there. And so in a period where interest rates have come down and down, you would expect property prices to go up and up. And equally, in a rising interest rate environment, it really just means that the person who goes to buy your house from you, when they go to the bank, they're offered, even though they might have the same income that you had when you first bought the home, when they go to buy it from you, the bank will lend them less money because the interest rate is higher. And so property is sensitive to interest rates. It's also sensitive to population growth. And this is, an argument that you'll hear a lot when people are saying, why are properties in certain areas going way up in value? And sometimes it's just that people have moved to that area. 200 years ago, New York City was farmland. Now it's filled with people and businesses and skyscrapers, and people want to live there. And as people move there, there's no additional space, and so the space that exists goes up in value. So population growth will affect property value. So how should you invest in property? Like, what's the best way? Do you have to just buy a house, or what should you do? What type of property should you invest in? Because you don't just have to buy a house. You could buy a business premises. You could buy, you could buy raw land that can be developed. There's many ways of investing. What are the risk factors? There's a number of years ago, I had someone tell me that there was no risk associated with property investment. I wouldn't agree with that. And finally, what are the costs? Because there's always transaction costs, right? There's the real estate agent wants a fee. The lender wants a fee. Who else wants a fee? Everyone wants a fee. In the United States, sometimes you have to pay for things like title insurance. They've got what they call closing costs, and these are all parts of the expenses. And then there's other costs of owning property, as I mentioned earlier, things like that you have to repair the property. Once in a while you need to call a plumber in, or you need to call a carpenter or whatever it might be in to fix something in your house. So there are costs as well. You can't just look at home prices and say that would be your expected return. So long-term returns of property. So can assets like this grow other than as a function of population? Now, let's think about, I refer to property here as a non-producing asset, because there's nothing sort of additional that comes from it. It's just, we mentioned earlier that you'll get a rent payment for it, but there's no good being produced. With a company, they're often taking some sort of, if you invest in stocks, there's an underlying company that might be taking some sort of resource, adding value to it through some sort of work, and selling it at a markup. So there's production occurring, there's value being created there. With property, there's often not really value being created. There's no, except if it's like a building. But once again, that's an equity investment where you're investing in a property developer, for example. But if you're just buying a house and renting it out, or living in it and hoping it will increase in value, other than with population growth, is there a reason to expect your property to go up in value? So Many years ago, I met with a group of people from Grosvenor Group, which is the largest property owner in the UK. It's actually the property ownership arm of the Duke of Westminster. It's his business. And they own essentially everything you might want to own in central London. They own, like when they showed a map of London and the properties that they own in London, it's almost all of the good properties in the best neighborhoods, and they've owned this since it was granted to William the Conqueror, so it's a solid portfolio of property. And their argument actually is that property values in the long run, and they're really taking a long run point of view, like they're not owning this for 20 years, like this is something that will be handed down to future Dukes of Westminster, and they argue that in the long run, property prices can't increase at a rate greater than incomes. And if we think about it, if you are, we'll say, a doctor and you buy a house, the kind of house that a doctor would live in, and you live there for 50 years, and when you go to sell it, maybe it's still the kind of house that a doctor would choose to live in, and so you'll sell it to another doctor, and he can only pay you some sort of multiple of his income, right? It's sort of capped by essentially people's incomes, right? Because you can't expect, if there's a lot of people and they'll tell me that properties have doubled over the last 10 years, so you can expect that to happen every 10 years going forward. And the problem then is, how do they expect people to ever be able to afford? You've eventually got this situation where only a Russian oligarch could buy, what would be considered low-income housing today, if it's going to go up at a rate of return like that. And so their argument is that in the very long run, it'll only go up at the rate that people's incomes go up at. And people's incomes tend to go up at the rate of inflation. So actually, they view property investments as sort of a stable but low return business. And they say it'll grow at the rate of inflation, less costs, which is maintenance, repairs and taxes. And so that is what they, the largest property investors in the UK, feel about property as a very long run investment anyhow. Long-term housing returns, well, let's look at what they've actually done. We've got here a chart from 1890 through to, I think it's around 2015 or so. It's the Case-Shiller House Price Index adjusted for inflation. So it's the real returns, the return adjusted for inflation. And as you can see here, it's kind of largely gone sideways for a long time, had a big spike, and it hasn't actually done awfully well. And so a lot of people, their parents or their grandparents have done very well in property, but that's often, it can be argued that that's because they bought these homes at a time when everyone was able to borrow money to buy a house, when, a couple of 100 years ago, not everyone, you sort of found a bit of land and you built your own house on it. And nowadays, people can go to the bank and get a loan. And of course, when everyone can buy a house, that does push up the price of houses. But then maybe that's done. Now, I don't know. I can't tell you what the expected return on anything is, but I can tell you what the inflation-adjusted historic return is. And as you can see in this chart, it's not as impressive as maybe the property bulls would tell you. What else have we got? Home prices versus stock prices from 1891 till present. And so our green line there is the stock market. It is the inflation-adjusted S&P 500. So that is stock market returns adjusted for inflation. And as you can see, the purchasing power has gone up hugely, over that period. And home prices have kind of largely gone sideways, up a little bit. So, and that should make sense to you, because essentially one is a producing asset. Like I said, it's a business where they're taking raw materials and adding value to them and selling them at a markup. And so in the long run, you would expect all of that human work to pay off more than the value of a piece of land does. And so that's what we find, home prices versus stock prices since 1891. So, you can take that into account with your investments. What else have we got? So many people feel that the only way to invest, so how do you invest in property? Well, a lot of people think that the only thing to do is to buy an actual house or a business premises and rent it out. But of course, there's many ways of doing this. And the problem sometimes is that people put too much of their money into property because they think that this is the only way to invest. But of course, there are other ways. There are things called real estate investment trusts, which are investment trusts. They get certain tax advantages if they pay out all of the rental income every year. And so they typically have a sort of a high dividend yield. But these are property companies that can give you exposure to all sorts of properties. They could be hotels, they could be business premises, they can be shopping malls, they can be houses. And you can invest a small amount of your money in these rather than all of your money, and that is another way of investing in property. So you don't just have to sort of buy a house and rent it out on Airbnb. You can invest other ways. Now, obviously, there is a drag on the return of investing in these because there's all of these managers and employees that are getting paid that aren't getting paid when you buy and rent out your own house. But of course, the problem is that you're doing a lot of work then, yourself. So that is another approach, I guess I would say. Stocks versus bonds versus real estate. So we have, a bunch of different, this slide is just showing what you get if you invest 100,000 into a bunch of these different asset classes, and how you've done in the long run. And so, as expected, stock prices have done better. But there's a few other things that are worth noting, because even though stock prices might have outperformed house prices, usually people put their savings into the stock market, while often people they put borrowed money into buying a house. And so the truth is that if house prices went up by 2% and the stock market went up by 10%, but you borrowed most of the money through a mortgage that you put into a house, you might have returned for yourself greater than 10% by investing in properties, simply because of this leverage, the fact that you are using borrowed money rather than your own money. So that's another thing that can be taken into account. And of course, banks will allow you to borrow significantly more money to buy a property than they will to buy stocks. They're not going to lend you much money for your stock portfolio, but they'll lend you quite a bit of money to buy a house. So that is a big difference. What else can we invest in? Well, other things we can invest in are commodities. Now, a number of years ago when I graduated from my master's degree, commodities were kind of the hottest thing around. And they tend to, it tends to change. Commodities can be really hot and then no one cares about them and then they come back. It's a very cyclical business. What do I mean by commodities? Well, here's a bunch of them on the screen. We've got gold, we've got oil, we've got agricultural products like we've got wheat or soybeans, all of these things. And there's tons of them. There's orange juice futures, there's, you name it, you can invest in it. Commodities, though, are sort of the raw products that come from the land, kind of like our gold, our oil, and our agricultural products. And so these are things that people can and do invest in. So let's talk about why they do that and whether it's a good idea or not, or how it should be approached. So why invest in commodities? Well, what's the expected return? Let's think about this. If you're to buy gold or if you're to buy oil and store it and hold it, we'll say for 20, 30, 40 years, what is the expected return like? Why would that product increase or decrease in value? There are, of course, drivers to the price, but we need to think a little bit about them. Are they volatile, right? Because we're talking about risk and return always. Are commodities volatile? We need to work out, if they do have an expected return, also what is the risk associated with that investment? How do you invest in commodities? We kind of know you can open a brokerage account to buy stocks or bonds. We know that you can buy a house to invest in property. How do you invest in corn? Well, we'll talk about that. Are they liquid? Are they, by liquid in finance, we always mean can you usually sell it quickly and at a price close to the going price in the market right now? And so, these are all of our questions. Well, what is the expected return? Well, in the very long run, they don't have much of an expected return. And so we've got here from 1871 through till present, the returns of baskets of commodities, and they tend to go sideways or down. Why does that happen? Well, it's just the nature of these things that almost if the price goes up, people make more of them, right? Like if gold went way up in value, people would devote more energy to digging it out of the ground. If corn went way up in value, people would devote more, farmers would plant more corn because it would be profitable for them. And so all of these commodities, they tend not to, the idea of like, should you buy something and put it in your retirement account for 100 years? There's not a great argument with the commodities. There's even a lot of the people who talk about gold as an investment. They talk about it as the idea that if you put money in gold, there's some story that they always tell you. The gold guys, they'll tell you that 1,000 years ago a nice suit could be bought for a gold coin, and today a gold coin is worth, we'll say, about $1,000, or I don't know what it's worth, but about the price of a good suit. And so they'll sort of say that gold is real money, and if you buy gold, it's a hedge against inflation, because your gold coin is always equivalent to a nice suit. That's an argument, and maybe some of the argument for commodities investments is that they are a hedge against inflation, because if there was huge inflation, you'd expect these things to inflate in value too. I would argue that a lot of the people who've done well in the commodities market tend to be traders. They don't do a long-term hold. They buy them when they think they're going to go up, and they sell them short when they think they're going to go down. How do they do it? Usually through futures, but you can, of course, actually buy the underlying and store it if you're kind of a big enough trader. As you can see here, the long run expected return just isn't that exciting, you shouldn't really expect it to be either, unless you think that, there's going to be a population explosion and we'll run out of the stuff that we need. And, with certain things, maybe there's an argument for that in the very long run. But in the last, couple of hundred years, we haven't really seen that happen. Are they volatile is the next question. And so here we have a chart, I think it's from around 2000 through till present, of the Goldman Sachs commodity index. And as you can see here, it's gone up and down quite a lot and largely gone nowhere. Now, in truth, if I had cut this at a different point, if I had taught this class in 2008 or something like that, we might have been able to say they'd done awfully well. But the truth is, in the very long run, they don't necessarily go up an awful lot. They sure do expose you to volatility. And so I would argue, and this is just my opinion, that maybe commodities are more of a trader's rather than an investor's market. But it's up to you to decide. I'm just putting forth ideas here. Are commodities an asset class? A few years ago, back in around 2007, there were a lot of people arguing that they were a new asset class, and that in fact investors should be putting 10% of their retirement account into commodities. Now, at the time I questioned that. I don't know that like my mom should be hoarding corn as a retirement asset. It's not obvious to me why that would be the case. The other problem, of course, is that there aren't enough of them, right? If everyone in the world were to put 10% of their money into commodities, there aren't enough commodities to go around for that to happen. It's a much smaller market than than the stock market or the real estate market or the bond market. And so there's not really room for it to be a huge asset class. It will, in truth, it will always be a bit of a niche thing for a certain type of investor who feels they have a certain expertise in that space. And there do appear to be people who do have a great expertise in investing in these products, but I don't know that they're for everyone. What else have we got? Foreign exchange. So foreign exchange is once again a thing that's often put forth as a possible investment asset class. Once again, I'd make a lot of the arguments I made about commodities for foreign exchange is that in the long run, it's converting, one country's money into another country's money. There's no reason to think that if you hold other countries' money, that will increase in value against your own, unless you live in a terrible country where you expect everything to go wrong. There's not really an expected return associated with foreign exchange. So really, once again, we've got this idea that it's kind of it's something that's there because it has to be there because different countries use different currencies. How do you invest in it? Well, there's many ways. You could go down to the airport and buy some money at one of those holiday exchange places. But usually, once again, people do this through futures, or you can trade in the cash market as well on a large scale in foreign exchange. But once again, I would say that you probably, as we argued earlier, should invest in foreign companies and maybe foreign bonds and things like that. But as to, investing purely in foreign exchange, there's no real reason to think you'd have a positive expected return. And then there's an awful lot of people who just feel they'll be lucky. They kind of say, I kind of know when the pound is going to go up or down against the dollar, and I know what to do. And so, if you feel that way, best of luck to you. But as a long-term investment, I wouldn't really argue that it should take the place of things like stocks and bonds or real estate or other asset classes in your portfolio. Other things, so things like mutual funds or other kind of collective investment schemes, what are they? Well, what they are is an investment vehicle open to all investors, including unsophisticated investors. Now, the term unsophisticated investor is not sort of an insult to a certain type of investor, but it just means that these are sort of classified as reasonable investment schemes or pools for everyday people to put their retirement money into, and you shouldn't need to be a real expert to invest in these. They're usually very highly regulated. They're not allowed to trade in things like derivatives. They're not necessarily allowed to short stocks usually. And basically, they're often, the goal is that they be sort of a low fee way of investing in the stock market. And the real reason that a person should invest in one of these rather than just buying their own portfolio of stocks is if you don't have enough money to buy, we'll say 20 stocks, like a diversified basket of stocks, you're able to put often as little as $1,000 into one of these mutual funds, and then you get the return of the stock market from it. There's lots of stuff that you can research about this. Often, there's a lot of research that shows that actively managed funds have not outperformed the index in the long run, and that should be expected, just to be clear, because if you think about it, if you look at all mutual funds, they're going to, on average, own all of the stock market, right? All of, if you average out all of their holdings, it's going to be the stock market, and then they're charging a fee. And so their expected return is the return of the stock market less the fee on average. Now, some do well, others don't do as well. If that's down to investor skill or not, I'll leave that up to you to decide. In this day and age, more and more people are saying that it's not, it's just luck, and that you should only invest in index funds. But equally, there are a lot of people saying that it's becoming problematic, that if everyone invested in index funds, then there's nobody out there doing the sort of work on analyzing whether a company is a good or a bad company. And we'll come back to that idea in a little while. Hedge funds then are an investment vehicle open to sophisticated investors. So what do I mean by that? Well, basically, hedge funds are kind of like mutual funds, but they're under significantly less regulation in that they're often allowed to use leverage, they're allowed to short stocks, they're able to invest in all sorts of crazy products if they want to, and they're allowed to kind of do what they want to, but they can't sell to everyone, right? So what they get in that additional freedom, they give up in that they're not allowed to market to the general public. So if you manage a hedge fund, you can usually only take in what's called accredited investors, which are usually, the definition changes over time, but it's usually, it basically means someone with enough money that if they gave it to you and you lost it for them, the government wouldn't have to bail them out, So what the government don't want, or what governments don't want, is mom and pop investors to put their money into kind of crazy schemes that then go wrong and then they're unable to afford their retirement. That's a big social problem. And so they sort of set aside these highly regulated funds that are mutual funds, and everyone can invest in those ones, and they're just fine. There's nothing wrong with them. They're just highly regulated. Then there's a less regulated version of that, and we'll talk about what kind of strategies they do in next week's class. But basically, the kind of person that can invest with them is either an institutional investor, so sort of a big sophisticated investor, or a very wealthy individual who can afford to lose the money. And so why do they invest? Why would they pick a hedge fund? Well, usually the fees are significantly higher than a mutual fund. And so that's a bit of a downside. Often the fees are 2 and 20, which means 2% of assets under management and 20% of the positive return of the strategy goes to the fund manager. So the fund manager actually is paid quite well out of this. Why would someone sign up to this? Well, often there's a few arguments. One is that they just really believe that this person is a great asset manager, and I'll allow you to decide whether that's a reasonable expectation or not. Other reasons, though, is that often these strategies are complex and uncorrelated to the stock market. And when I speak about them next week, we'll learn kind of what these things are and why it's very reasonable to expect them not to be up when the market's up and down when the market's down. And so if you've got these uncorrelated strategies that have a positive, we'll say if they have an expected return that's similar to the stock market, but they're entirely uncorrelated, well, that brings us back to yesterday's class. It brings us back to the idea that this uncorrelated asset class should dampen the volatility of your overall portfolio. So that is the real reason that sophisticated investors invest in hedge funds, is just this idea of getting an uncorrelated return that might have a similar expected return to the stock market, but is just uncorrelated, and thus reduces the volatility of that investor's overall portfolio. Private equity is our last one here, I think, and it is a term for a type of fund that invests in equity in operating companies that are not publicly traded. Okay, so this is all of that. Venture capital usually falls in as private equity as well. Now, once again, the fees are often higher on private equity than they are. They definitely are higher on private equity than they are investing in a mutual fund. Once again, you usually have to be an accredited investor to invest in this. And the idea is that they can put you in these that there's a good asset manager who's picked these good investments that are not available to the general public. Just you can invest in it. So we'll say if it's all of these companies that have not yet gone public, like a number of the kind of hot tech stocks, for example, or often they might even be buyouts, where there is a public company and a private equity company buys it, and then they say they can run it more efficiently under private ownership than it could have been run as a public company. And they'll argue maybe that this is tied to the fact that they're not, the management aren't worried about quarterly earnings, and instead they're focused on the long term. Or there's a bunch of different arguments as to why it might be managed more efficiently. Maybe even there's a lot of cost cutting when you don't have to have a big team of accountants and regulatory experts to make sure you're compliant with the various exchange requirements and so on. But in truth, in the very long run, it would seem to me that when you're investing in private equity, you essentially have ownership of a business, which is a lot like public equity. And so, it's not obvious to me that you should expect a hugely different return from private equity than public equity. Sometimes, though, and we'll talk about this in next week's class, some of the reasons that private equity might do well is that often they buy a rather large share or even all of a company. And if they're buying a rather chunky position, sometimes they're able to negotiate a better deal than the regular equity investors are able to negotiate. So maybe instead of buying common equity, they might invest in some sort of special security where it's a convertible bond, where they'll receive interest rate, but if things go well, they get to convert it into stock, or they, preferred securities, all sorts of things. And so often they can negotiate that out of the sellers of the company. But of course, the other side of that coin is that the only person who'd be willing to agree to giving you such a good deal is someone who feels that their company isn't as good as maybe they're telling you they think it is. So once again, it's up to you to decide. But really, the reason people typically invest in private equity is, once again, this diversification argument. Then the last little thing we'll talk about here are ETFs, electronically traded funds. And these used to be kind of a new thing, probably 20 years ago, but they're a newer way of investing. And they're a lot like a mutual fund, only instead of you putting your money into this sort of pool that then gets invested at the end of the day, the mutual fund just prices once a day. An ETF is a basket of stocks that's traded as if it was one stock on the stock market, so you can buy or sell this. It has revolutionized the investment world. There's huge growth in assets. Like, this is sort of the hottest way, I guess, in recent years to invest. There's been all of this growth here. Usually initially it was a form of indexing, where it would be like the SPY is an ETF, an exchange traded fund, and it just tracks the S&P 500. So basically you buy a share of the SPY, and that money is used to buy the 500 stocks that are in the S&P 500. And so that's how it works. Usually they have low fees, lower than hedge funds, private equity, and mutual funds, because they're usually passive investments. And usually the purpose of these is to capture sort of a specific beta, like we'll say, for example, if you wanted to invest, if you thought that the oil industry was going to do well, but you didn't want to pick an oil company, you could invest in an energy ETF that might be diversified between 20 different stocks. And so you buy it and you've got this energy exposure that you wanted, but it's sort of diversified energy exposure. Or you could just buy one that is the S&P 500 or the FTSE, or any index that you want. And in fact, there's all sorts of bond ones and things like that. And actually, if you're interested in looking at it, in 2020 there's a lot of news right now, March 2020, about a lot of the fixed income ETFs, because what's happening is that the ETF has become more liquid than the underlying bonds. So when people are selling bonds because of this whole coronavirus scare at the moment, they're dumping the bond ETF, and the problem is that the ETF can't sell the bonds as quickly as the ETF is being sold, and so the ETF is trading at a discount. And there's some rather significant discounts associated with ETFs right now, and there's a type of investor that would buy that ETF with the idea that that you can buy it below its NAV, its net asset value, and that maybe that premium will come back. it's not always obvious. Maybe one of the reasons it's trading at a discount is just that the bonds are mispriced and the ETF is actually accurately priced. Once again, I'll let you decide what you think about that, but that is exchange traded funds. Next up, we have collectibles, right? Because you don't just have to invest in sort of these standard things. You can buy, paintings, classic cars, stamps, antiques, wine. There's all sorts of investments like these. Here we have gosh, I've forgotten his name now, the drummer from Pink Floyd, who owns this Ferrari 250 GTO, and he paid $35,000 for it in 1977. He said, "I felt stupid to be spending so much. I never thought it would be worth 30 million in 2016." So obviously that's worked out quite well for him. And Nick Mason, that's his name, so it took me a while. But anyhow, so that is an example where it worked out. But of course, there's many examples where it doesn't work out, where someone buys something and it, rusts and causes all sorts of problems. There's all sorts of maintenance costs. And there's many issues associated with collectibles. So risks of collectibles. I'm not sure if any of you guys know what this is, but this is what's called a Beanie Baby. And this was a big collectible in the late 1990s. And these little bears, these, kind of $2 or $3 bears, were trading at hundreds of dollars because a lot of people said that this is a really collectible thing because they only made them on sort of short runs, and there was like a Princess Diana bear and a Jerry Garcia bear and all of these things. And, they kind of became quite valuable for a while. Today, you can probably pick them up for about $2 or $3 because they're little bears, that's what they're worth. But, so there are risks associated with them. Risks are maintenance. With the Ferrari there, if you had bought that Ferrari and just left it out in your backyard for the last 40 years, wouldn't look like Nick Mason's one does. Maintenance can be a big cost. Storage, certain valuables, you have to pay maybe a lot of money to store them. Aging, wear and tear. Insurance, often if you've got very valuable collectibles, you will have to pay to insure them. Otherwise, someone could break into your house and take your Picasso. Fashion, sometimes you always hear about the person who bought something before it was interesting and then it became really cool and really valuable. And a good example is kind of a lot of toys that have gone way up in value, like early like Mickey Mouse things or Star Wars toys or whatever they might be. And people then think, oh well, I'll buy the new version of that and it'll be worth a fortune someday. And the problem with that is that, for one thing, certain of these toys sort of came into fashion and years later people sort of really cared about them. But other ones, for all of the toys you could have bought, most of them are landfill right now. And not only that, the reason those ones became collectible was that children played with them and broke most of them, and there's not many left. While if you've got all of these people stockpiling, the new Star Wars toys and keeping it in the box, and and everything been sold as if it's hugely collectible, the problem is that in 50 years' time there'll be a ton of them in perfect condition around, and thus they won't be rare or valuable. At least that's my opinion. A theft is an issue. Sometimes the problem with having valuables is people steal them from you. And then bubbles. Obviously I put the Beanie Baby here as an example of bubbles, where there are people who have spent hundreds of dollars on these things and they're worth nothing now. But I imagine if you spoke to that person, they'll tell you it's going to come back. It'll be huge in a few years. So collectibles, they are what they are. I would argue that you should buy them if you like them. Don't necessarily buy them to make money. I would also argue that you could argue that they provide diversification benefit, but another argument is that in the event of like a stock market crash, does anyone really want to buy your Beanie Baby from you, or even your Ferrari? Like, that is going to fall in value if during the credit crunch, a lot of these exotic cars and things like that were really cheap, and they were really cheap because the kind of people who could have afforded them couldn't afford them anymore, or were afraid of them, or had lost a ton of money in the stock market and didn't feel like going out and dropping a load of money on an expensive car. So that is collectibles. And so finally, asset allocation. What is asset allocation? It's the process of choosing amongst possible asset classes. So there are all these asset classes, and you can choose what to put your money into and how much to put in what. Usually the fundamental justification is diversification and this idea of reducing the overall risk for a given level of return. And the reason you might want to be in a bunch of different assets is that in different years, one will do well and another won't, and so on, and it might smoothen out your return. And so here we have a chart that I've updated. It's from, I think this is from JP Morgan, and it's 2006 through to present, through to February 2020. And you can just see here each of the different colors. The green one here is emerging markets, and they did well, horribly, well, medium, up, down. And as you can see, all the colors, they kind of move around, and each one is a different asset class. And so this sort of shows you why people want to invest in a bunch of different asset classes. It's because maybe if you don't feel you can predict which will do well in the coming years, you just own them all and you get kind of an average return. But equally, you can understand why people try to allocate it. They try and pick which one they think will do well in the expected environment going forward. So what are our takeaways? Well, there are numerous asset classes with different risk profiles. And whenever you're making an investment, like, in many ways, there's a lot of people watching this who possibly won't agree with my assessment of the risk and return of various asset classes. And there's people who say he's crazy with his idea that I shouldn't invest in Beanie Babies or whatever it might be. And you don't have to agree with me. Some of these things are just my opinions, but there's a bunch of different things that you can invest in. And if you're going to invest in something, you should always think, well, what are the alternatives? If I could put my money in this, there's also 5 other things I could put my money in. Which is the best one? And then it's also worth thinking about what are the drivers of prices. Because even, where I said that commodities in the long run don't do well, maybe you feel you have a good reason for knowing why a certain commodity is likely to do well in the short run. But it's worth thinking about what those drivers are. You don't just buy things without thinking like, why would a house move up in price? Why would a stock move up or down in price? Why would a bond make sense as an investment? And so we have to think through all of these things in order to make wise investments. Adding asset classes can improve diversification, and that's kind of a lot of what we've talked about here, is just that these different investment types are quite different to each other, and so it's reasonable to expect them to give you a diversified portfolio if you own a few of them. Expected risk and return of each component in your portfolio does matter, and it's worth thinking about that rather than blindly buy something because someone says, oh, you should have 10% of your money in commodities. You have to think, well, why would commodities go up, or why might they go down, or what makes this thing a good investment? And you might come up with many really good arguments that I haven't even thought of, but you have to think about them. And so with that, I will say goodbye, and I'll put up another video tomorrow. See you then. Bye.